Hello and welcome to Mayor Brown's Supply Chain Disruptions Key International Tax Issues webinar. I'm Mike Leibowitz. I'm a partner in Mayor Brown's Los Angeles office and a member of our tax transactions and consulting practice group. Joining me today as co-presenters on our webinar are colleagues from our global tax practice. They include Jason Osborne, a partner in our Washington, D.C. office, Astrid Piron, a partner in our Brussels office, Matthew Mortimer, a partner in our London office, and Kitty Swanson, counsel in our London office. You've got bios of all the presenters on the left side of your screen. You can scroll down to get the bios of all of the presenters. Before we begin, I'd like to mention a few housekeeping items. When you're accessing our webinars on the On24 platform, we suggest avoiding Citrix and other desktop visualization software as that will decrease quality, create some disruption. So we suggest not logging in through Citrix. Secondly, you've got an FAQ panel on the right side of your screen. That'll indicate that today's program is being streamed to your computer. There's no dial-in number. So for the best audio, use your computer speakers or headset and make sure the volume's turned up as much as needed to hear the presentation. If you've got questions during the presentation, there's a Q&A feature on the screen, on the left side of your screen. And if you put questions in there, we'll do our best to follow up with you after the webinar has ended. CLE is being offered in connection with this webinar, and midway through the presentation, we'll be providing you with an alphanumeric code. In order to receive CLE credit, you must record this code on the virtual sign-in sheet that was emailed to you with the login instructions for today's program. These forms are also available to download on the right-hand side of your screen under the resource list if you need them. You'll get a follow-up email after the program with a link to enable you to download the slides. And so with that, let's go ahead and get started. Why we're here today talking about supply chain disruption. And we'll focus on some key issues, in particular some of the transfer pricing challenges associated with supply chain disruption. Is this the time to be adjusting margins for limited risk distributors? Is this the time to be adjusting interest rates for intercompany loans? And we'll discuss some of the challenges associated with that. Next, we'll talk about some tax issues associated with functional dislocation. Employees working from different locations, functionality being disrupted as a result of the crisis. We'll talk about some of the PE, residency, controlled foreign corporation, and DEMPE issues associated with that. Then we'll turn to some indirect tax issues associated with supply chain disruption and what some of the challenges are there. We'll finish up with some concluding remarks and tell you about some upcoming resources and other webinars that are coming up in the future. So some general observations on what's happening from a supply chain standpoint as a result of the COVID-19 crisis. Supply chains are being disrupted. Distribution channels are changing. Distribution centers are being shut down. A third-party distributor might cease operations as a result of the crisis. Similarly, a contract manufacturing operation may be temporarily shut down, or you may have to, a multinational may have to shift contract manufacturing quickly to another site. It's obvious that distribution margins are under pressure, and that has a knock-on effect on margins throughout the supply chain. Employees are working remotely or having different responsibilities. They've been asked to do different things. They're either exercising more functionality or less functionality depending on their situation. As you all know, because you've you've signed up for this webinar that tax is a key component in every supply chain structure. And so when that structure is disrupted, important tax considerations arise. And so the purpose of this webinar is to touch on some of those key tax considerations. And so with that, I'll turn it over to my partners, Jason Osborne and Astrid Pirone, to address some of the transfer pricing issues associated with the disruption.
Thanks, Mike. We'll now talk about the transfer pricing challenges associated with the COVID-19 crisis. Any transfer pricing analysis, whether in normal conditions or in the current unprecedented conditions, should always begin with an analysis of the relevant intercompany agreements. Well-drafted intercompany agreements for distribution structures or other transactions should reflect the functions, assets, and risk of the parties. Intercompany agreements, they frame the intended tax characterization of the transactions between the parties and are particularly important since both under the Section 42 regulations in the U.S. and the OECD transfer pricing guidelines, intercompany agreements, including the risk allocations embedded in these agreements, are normally respected by the tax authorities as long as they're consistent with economic substance. In other words, as long as they reflect commercial reality. So for this reason, agreements provide the first line of defense in transfer pricing audits. A limitation of intercompany agreements that we're beginning to really appreciate right now is most are drafted for normal operating conditions. Typically and generally, these agreements do not specifically address the consequences to related parties of unanticipated catastrophic events, and particularly not events of an unprecedented magnitude like the current COVID-19 crisis. Although, like, very few intercompany agreements will address catastrophic events directly, as we'll discuss in detail, many do contain typical, seemingly boilerplate commercial terms like force majeure or hardship provisions, which not a lot of attention may have been paid to in the past, but may be now more relevant than ever before. So how exactly should intercompany agreements be interpreted in the current environment when parties are starting to incur catastrophic unanticipated losses? In short, very few intercompany agreements are exactly alike, so the terms of each agreement need to be reviewed and considered individually. This slide provides two examples of different but typical types of intercompany distribution agreements that would likely provide different answers, but then again, in each case, the devil is in the details. The first example is that of a limited risk distribution agreement, or LRD, in which the LRD is provided with a guaranteed fixed margin. It's effectively a contractual guarantee of profitability, and for all residual profit or loss to inure to the principal. Under LRD agreements, the principal is intended to bear most, if not substantially all, of the market and the other economically significant risks of the business. The second example is one of a so-called routine or full-fledged distributor. In such agreements, the distributor would have no contractual guarantee of profitability and would be subject to more market risk than the LRD, but nevertheless, it still wouldn't have a lot of risk since, generally speaking, distribution is not a highly risky business activity. The $64,000 question in both examples is whether you can push down the current unanticipated catastrophic losses that we're starting to see more frequently to the distributor. In both cases, the short answer is maybe. The position will be harder to support in example 4 than in example 2, but certainly not impossible. Even in the case of an LRD, if you have an actual or perhaps even an implied force majeure or hardship provision, that may provide support for your position. And even in absence of such provisions, you need to consider whether catastrophic losses are simply just outside the four corners of what the agreement is intended to cover. As these two examples highlighted, as a starting point, it's very important to maintain and carefully consider the terms of existing intercompany agreements even if they were designed for so-called normal conditions. There will certainly be difficult interpretational issues and judgment calls that will need to be made that call for rigorous analysis and documentation of whatever position you ultimately decide to take. A related question is whether a multinational should at this time be entering into new intercompany agreements and or amending its existing agreements in order to specifically address COVID-19 related losses and other issues. In many cases, I think the answer is yes, although with a caveat. Even if such agreements are not strictly contemporaneous, they can still be an important, persuasive part of an overall strategy to document uncertain transfer pricing positions. This said, as a caveat, tax authorities generally do not have to respect agreements that are entered into with hindsight. An agreement that's entered into now that we know that losses are likely, is not going to carry the same persuasive weight as an agreement entered into last year before COVID-19 could have been foreseen. But in any event, an agreement entered into now will still be a lot more persuasive than an agreement that you might enter into, say, November or December. Moving beyond intercompany agreements, another related key challenge is transfer pricing documentation, and in particular, locating good comparable companies for 2020. A key comparability factor in any transfer pricing analysis for comparable company selection is comparability in terms of economic conditions. It goes without saying that economic conditions in 2020 are unlike those in 2019 or any other year. In an ideal world, I think it would make sense to hold off on preparing transfer pricing documentation for 2020 until 2020 financial data for comparable companies is available, so that you can have an apples-to-apples comparison of a related party distributor's 2020 financial results to those of comparable companies that are similarly adversely affected in 2020. But a problem is that full year 2020 financial data generally will not be available until 2021. This might not be a problem for some calendar year taxpayers, which might be able to take a wait-and-see approach and do post-closing compensating adjustments in early 2021, but this is less likely to be viable for multinationals with earlier fiscal year ends, for example, March 31st or June 30th. And it's also likely not to be viable for distributors and jurisdictions that under local law just do not allow retroactive transfer pricing adjustments. In these cases, more difficult judgment calls may need to be made. In addition, other well-established benchmarking practices that multinationals may have used in their documentation in the past may now be drawn into question. For example, because 2020 is unlike any other, multinationals that use multiple year analysis to support results will need to think long and hard about whether such approaches still make sense. And then likewise, for distributors, it's common to use large sets of distribution comparables that are functionally similar but span many industries. Given how COVID-19 has really had a disparate effect on different industries, catastrophic effects on some and minimal or even positive effects on others, it may be time to rethink the large set approach to documentation.
So Jason, let me ask you a question on comp sets here. So if you have a comp set that you're using to support your transfer pricing documentation, does it make sense for multinationals to take a look at the companies in their comp set? Because if they're relying on one or two particular companies, would it make sense to take a look at the financial performance of those companies now, so they can see what possible changes or what impact might arise on their comp set when they get ready to do their documentation?
Mike, absolutely. I think in the current environment, multinationals need to be proactive, and that would mean doing preliminary analysis and start looking at preliminary financial results, quarterly results for comparable companies sooner rather than later. So with that, just to segue, what else should multinationals be doing right now with a view towards preparing their 2020 transfer pricing documentation? In short, there's no single answer, but in general, what worked in the past probably will not work now, probably will not work for 2020, at least not without modification. For most multinationals, now is the time to take a fresh look at the transfer pricing policies and documentation strategy and think outside the box. Although it's by no means a perfect analogy, approaches that had been developed during the financial crisis of 2008 and 2009 might be worth reconsidering now. Some of the approaches that analysts developed in the financial crisis included, among other things, doing transfer pricing analysis using financial data from the last recession, which then was in 2001 and 2002, and also doing analyses with very long time horizons, for example, 10 years, in order to take into account complete business cycles. So these are just a few examples. And with respect to loss allocation, comparables may not provide the answer at all in many cases, so novel approaches may need to be considered. In a recent development, IRS transfer pricing documentation frequently asked questions released earlier this month provide timely guidance to taxpayers on addressing current transfer pricing related challenges. Although these FAQs were not written with COVID-19 in mind, they nevertheless provide reminders of best practices and are as relevant now as ever before. In particular, there's a very relevant FAQ, FAQ number 1, which addresses a situation where a distributor incurred a loss in 2017, which was determined to be attributable to an unexpected decrease in demand for the distributor's products rather than to improper transfer pricing. The FAQ from the IRS's perspective explains it would be beneficial in an audit if a company prepares documentation that thoroughly explains how the unforeseen business circumstances experienced by the company caused the observed financial results and how the losses were not caused by intercompany prices. It then goes on to say that it would be counterproductive if, rather than addressing the business circumstances of loss, the taxpayer instead manipulated its set of comparable companies. So what I think the key lessons and takeaways of this FAQ is that economic analysis, while it's very important, only goes just far, and it's not necessarily the most important part of your transfer pricing documentation. In preparing documentation, too much emphasis is often placed to get a tested party's results to fall within an elusive arm's length range. A multinational trying to support the allocation of COVID-19 losses to distributors might be better off instead of pushing the envelopes with its economic and comparables analysis to instead just to build a very robust narrative explaining its facts and circumstances and qualitative arguments supporting its position. To discuss further the transfer pricing allocation of COVID-19 related costs and losses, I'll turn it over to Astrid Perron.
Thank you, Jason. COVID-19 related costs are often precedent scale for M&As, and the allocation of costs among members of the group should be reviewed and monitored from a tax and transfer pricing standpoint. The question is, should the cost be shared, and if yes, how? Is it appropriate for a group member that is only entitled to a limited or risk-free return to be allocated a share of such costs? The answer will be supported by an analysis of the rights and other assets of the parties, of the risk assumed, the economic rationale, and the option available to the parties. As earlier said, the contractual terms in the intercompany agreement will be very important for that purpose. Of an ongoing concern, what means the transfer of assets coupled with the ability to perform certain functions and assume certain risks. The support may also imply the transfer of something of value. The valuation of those transfers should reflect all the valuable elements that would be remunerated between independent parties in comparable circumstances. And of course, an appropriate legal and transfer pricing documentation is needed. Neglecting the identification of those transfer of value and their monitoring may result in severe tax costs. We refer to the Chapter 9 of the OECD transfer pricing guidelines for the guidance in this respect for topic business restructuring, and the tax consequences may include withholding taxes and issue with deductibility of payment. In some countries, it could be treated as hidden capital contributions. Jason, what about the U.S. BEAT consideration?
Yes, and for U.S. Multinationals, another concern is that payments from a U.S. Corporation to a foreign related party, whether it's to reallocate losses or if it's to compensate a value transfer, even if it's arm's length, it could unexpectedly trigger BEAT. So that's an additional trap for the unwary that multinationals need to be aware of.
To realign the supply chain, M&As may consider rescinding or terminating the related party agreements. There are two aspects to consider: the legal contractual clauses and the tax viewpoint. Regarding rescission, IRS and other tax authorities have allowed it in very limited circumstances. Regarding termination, it may result in payments for indemnification, as it would be the case between independent parties. Liquidated damages provisions or penalty clauses can be helpful in mitigating damages. This should be checked on a country-by-country basis. As earlier indicated, given the context, comparable data will be difficult to find by now. Stress on financial system may impact M&A financing arrangements and result in tax and transfer pricing consequences. From a tax viewpoint, debt equity considerations should be addressed if new funding is needed. For example, the guidance from the OECD BEPS Action 4 should be taken into consideration, as well as the limitation of interest deduction brought, for example, by the EU Anti-Tax Avoidance Directive, ATAT 1 and ATAT 2. Regarding transfer pricing aspect, the usual question should be raised. Would an unrelated third party land under the current business circumstances? Other aspects include the change in credit ratings that may impact the determination of interest rates and the potential need for guarantees from parents to support local entities. We have planned at the end of May a more comprehensive webinar to address the impact on financing arrangements, but in a nutshell, documentation will be key. As earlier said, the contractual agreements should be aligned. And from a transfer pricing perspective, a transfer pricing study should preferably be done before the funds are advanced, including a discussion on an allocation of unexpected costs. Corresponding adjustment to calculated credit ratings may be required.
And in addition to the transfer pricing aspects of changing intergroup financing arrangements, there's some important tax considerations as well, because changing an interest rate or changing a material term of an intercompany lending arrangement may give rise to a significant modification, which may trigger a deemed exchange of that instrument, giving rise to potential cancellation of indebtedness income and other consequences arising from the change in the term. And so, merely reducing, just a mere reduction of the interest rate just to ameliorate some of the impacts of COVID-19 may give rise to some significant tax consequences that need to be considered. And again, that will be discussed in our upcoming webinar as well. For those M&As that have significant import operations, any change in transfer pricing policy should also consider customs regulations. Transfer pricing studies are generally not fully accepted by customs authorities,
even though there are some progress in this respect. The customs authorities consider transfer price on a transaction-specific basis and assess them on import transactions based upon different rules than the tax authorities. To simplify the difference in views, we may say that for customs, the value should not be too low, but for tax authorities, the value should not be too high. To close this transfer pricing chapter, some recommended action. Review intercompany agreement to analyze how COVID-19 should be addressed for transfer pricing purposes. It's an obvious. Consider hardship, force majeure, and other provisions that may allow for one-time reallocations of profit or loss or possible termination. Document variances from transfer pricing policies that may be appropriate for 2020 as soon as possible and undertake the related transfer pricing analysis. Review impact of change in transfer pricing methods to customs valuation in the countries of importation.
So now that we've addressed some of the transfer pricing challenges associated with the COVID-19 crisis, let's talk about some other challenges that arise from the functional dislocation that the crisis is producing. And we'll first touch on some of the permanent establishment and residency issues that arise here. So first, just in general with respect to a permanent establishment. Employees working in a country may cause the employer to have a permanent establishment in that country and cause the employer to be subject to tax in that country under a relevant income tax treaty or under local law. And that would generally arise where the employee is working in that country through a fixed place of business on behalf of his or her employer, or where the employer has and is habitually exercising an authority to conclude contracts in the name of the employer in that country. Under either of those two circumstances, a permanent establishment would arise both under a tax treaty, but would also probably arise under local law as well. And what we're seeing as a result of the crisis is that we have employees that are stranded in another country as a result of travel restrictions or other limitations that might cause the employer to have a permanent establishment in that country where a permanent establishment would not otherwise have arisen. For example, the employee may be required to work in a location that is treated as a fixed place of business of the employer. Or the employee may be given additional authority to act on behalf of the employer just because of particular business exigencies. And in addition, a stranded employee, him or herself, may become subject to tax where their stay exceeds the number of days that would otherwise be allowed under local law or under the PE provisions of a treaty. Related concerns arise in the question of tax residency, because many countries use a central management and control test to determine whether a company is resident in that country for income tax purposes. And so an employee working remotely and acting in a management capacity or exercising managerial authority, for example, as a member of the board of directors of a company, may be exercising management and control in that country. And if that employee is stranded there or cannot, or is otherwise, stuck in a particular country exercising managerial or management and control authority, that may put pressure on the tax residency test. On the other hand, or conversely, if management control was expected to take place in a particular country because employees were resident in that country and were exercising management and control while they were in that country, if they can't get back to that country, that may give rise to a scenario where a company may cease to be resident in a country and thereby triggering exit charges or other consequences as a company loses residence in that country. So the U.S. and other countries have recognized the issues associated with stranded employees and functional dislocation and have started to issue guidance in this regard. Just last week, the the IRS issued guidance to provide some relief in connection with travel disruptions and some guidance in connection with what happens from a U.S. trade or business or a permanent establishment standpoint. And so generally, the IRS has provided in Rev Proc 2020-20 that the IRS will disregard presence of up to 60 consecutive calendar days in the U.S. for purposes of determining whether an individual is resident in a country or whether a company is engaged in a trade or business in the U.S. or might otherwise have a permanent establishment in the United States arising as a result of travel disruptions because of the COVID-19 emergency. And earlier this month, the OECD issued some guidance outlining some recommendations that countries should take to deal with the extraordinary issues associated with COVID-19, acknowledging that the pandemic has changed where and how cross-border employees are working, and indicating that in general that the COVID-19 crisis should not lead to permanent establishment or tax residency changes if a permanent establishment or tax residency would not otherwise exist because of through sort of the normal operations of the employees prior to the crisis. So more specifically, the OECD has suggested that an employee working from home because of the crisis, that home office shouldn't necessarily be considered a fixed place of business at the disposal of the enterprise. And so if an employee is working from home and wouldn't otherwise have worked from home pre-crisis, the home office is not going to be considered. The OECD is recommending that the home office not be considered to be a fixed place of business at the disposal of the enterprise. Similarly, if contracts need to be concluded at an employee's or agent's home offices because of force majeure or travel restrictions arising from government directives or otherwise, that a PE shouldn't arise just because of that. And similarly, the OECD has suggested that the pandemic shouldn't change the residency status of a company as a result of displacement of senior executives. And interestingly and importantly, the OECD went a step further and has acknowledged that if a company is receiving subsidies from a government as a result of the crisis, a question arises as to where that subsidy arises, or to where it should be attributed for income tax purposes. And the OECD has suggested that the subsidy should be attributed to the location where employment was exercised before the crisis, rather than attributing income arising from the subsidy in the country where where dislocated employees are working. So that's important guidance. So picking up the cues from the OECD, a number of countries have already started issuing guidance in this regard. Luxembourg, France, Belgium have issued guidance indicating that COVID-19 is a case of force majeure. And so as a result of that, employees working from home will generally not be considered to be resident there for tax purposes. And similarly, Belgium and France have also suggested that the presence of cross-border workers will not impact a residency determination. Luxembourg has clarified that workers can work for up to 24 days per year outside of Luxembourg without being subject to tax without being subject to tax in the other country, and that provision is going to operate for the foreseeable future until further notice. The UK has also issued similar guidance in this regard, disregarding days spent in the country because of COVID-19 travel restrictions or self-isolation. Australia was one of the first countries to issue guidance in this regard, suggesting that travel restrictions where employees are stuck in Australia because of the crisis, those employees will not be considered to create a permanent establishment or otherwise create tax residency for the company in Australia through central management and control if a PE or central management and control would not otherwise have arisen there prior to the crisis. Similarly, Ireland has also issued guidance saying that a taxpayer will not suffer negative repercussions for being present in Ireland because of travel restrictions. A related issue arises in connection with installation, construction, and building projects. Under most income tax treaties, a construction project, an installation project, is not considered a permanent establishment in that country, provided the project is temporary. The U.S. and OECD model treaties provide a 12-month period for testing whether the project is temporary, after which, exceeding that period, the project does become a permanent establishment. There was already guidance in the OECD commentary indicating that temporary interruptions in a project because of seasonal weather delays or other similar events don't extend the time period. So if you had a construction project that was due to last only 10 months, but it was delayed because of weather or hurricane or otherwise for 3 months, that's still considered to be a 13-month project, even though the project was originally only scheduled to last for 10 months and be under the treaty permanent establishment window. So there will be projects that will be delayed as a result of COVID-19, and just because of the unanticipated and unprecedented nature of the crisis, it will impact projects that were already in process that were expected to be concluded prior to the relevant treaty window. And so significant PE risk arises because of delays arising from COVID-19. If the project can't be completed because employees are not able to get back to the country, if you treat COVID-19 the same way that the treaty commentary treats normal, maybe more predictable weather delays, then there would otherwise be no relief as a result of a project being extended because of the COVID-19 crisis. None of the guidance that's been issued thus far deals with this issue, so it's an important risk factor if you've got projects in a country that are being delayed by the crisis. So shifting gears from PE and residency to controlled foreign corporation considerations. The CFC rules of most countries require that the CFC maintain a sufficient level of substance in order to prevent an income inclusion to the shareholder of the CFC. They might also provide for safe harbors from that inclusion where there is a sufficient level of substance that the supply chain is relying on to prevent a CFC inclusion. So, for example, in the U.S., the substantial contribution test for Subpart F purposes requires that the CFC be actively engaged in a number of functions supporting the manufacturing. In the UK, for example, a CFC inclusion may not be required if the CFC is not managing UK risks. CFC determinations are generally made on an annual basis, and so it's quite possible that in 2020, given employee dislocation and reduced functionality in a particular CFC, that a CFC might not meet the substantial contribution test, or might not be exercising, or might be exercising too much substance with respect to UK managed risks in the UK, that might cause the relevant CFC test to be tripped. So it's important, as with PE and residency, to be looking at what employees are doing and what they aren't doing, and looking at what CFC tests you're relying on to see if there's going to be, if COVID-19 is creating an issue in 2020. So in light of the crisis, employees of a CFC may not be able to perform particular functions, or the CFC may be required to perform different functions. As a result of that, there is a risk that CFC income inclusion will arise. Moreover, multinationals may need to shift production from one CFC to another, or back to the CFC's home country. That will change the level of substance arising in a particular CFC, which also might give rise to a CFC income inclusion in the shareholder's country. So there are a number of broad tax considerations here arising as a result of the crisis, as multinationals look to quickly change their supply chain as a result of the emergency. A related concern arises in connection with intangible property. And so many countries have implemented the recommendations of BEPS Action 8, requiring that an entity, in order for an entity to earn an entrepreneurial risk-adjusted return associated with intangible property, that entity has to have a sufficient level of substance, and that substance is generally referred to as the DEMPE standard, where the entity needs to perform important functions relevant to intangible property, including development, enhancement, maintenance, protection, and exploitation functions that are attributable to the IP. And so under this standard, in order for an entity to earn premium returns associated with intangible property, that entity needs to be able to perform or control those DEMPE functions within those DEMPE functions. So as with a CFC determination, functional dislocation also gives rise to DEMPE implications as well, because if an entity is not able to perform DEMPE functions in a particular country as a result of the crisis, that's going to put pressure on meeting the DEMPE standards, and may give rise to issues associated with whether that entity is entitled to a risk-related return associated with the IP in that year. And similarly, it's important to remember that DEMPE functions are also important in loss years, or years of minimal profitability, where there are no premium returns from the IP to allocate to that country. So when employees of a company can't perform DEMPE functions, there's a risk that a licensee will lose deductions for royalties, or the entity itself will not be able to, will risk not being able to be allocated losses associated with that IP for carry-forward purposes. So what should multinationals be doing now? At the outset, they should be reviewing their delegations of authority with respect to their key personnel that are working from remote locations, and identifying what authorities they have, whether those authorities have changed, and assess whether those delegations are going to give rise to PE, residency, CFC, or DEMPE risk. Remote board meetings are taking place as a result of the crisis. So physical in-person board meetings are obviously not happening during the crisis. And so those board meetings are taking place remotely, and so therefore they're taking place in all of the locations where the board of directors are meeting. And so documentation should be maintained as to where the board is deemed to be meeting, and why the meeting could not take place in the relevant country from a residency or permanent establishment standpoint, or in order to comply with local corporate law, where local corporate law requires a board meeting to take place physically in a country where that meeting can't take place locally. Documentation should be maintained as to why that meeting is not taking place there. But again, multinationals should be reviewing what their key personnel can do, are doing, while they're working remotely in order to assess the risk we've just discussed.
Thanks, Mike. Kitty and I will now deal with the indirect tax consequences of a disruption to a supply chain. The application of indirect taxes like VAT or GST to supplies of goods and services under a supply chain will generally depend upon where the supplies take place for the purposes of these taxes. As a result, an alteration in the provenance or destination of those supplies in response to the COVID-19 crisis may have indirect tax consequences. In the following slides, we will consider these consequences. In particular, we will describe the typical indirect tax treatment of cross-border and domestic business-to-business supplies, and discuss the indirect tax implications of modifications to a supply chain from the perspective of both the supplier and the customer. We will also touch on customs duties and then conclude with some recommended actions for those facing supply chain disruption as a result of the COVID-19 crisis.
The precise indirect tax consequences of a supply will depend on a number of factors, including the location of the parties and the nature of the goods or services being supplied. However, there are some general principles that apply in many jurisdictions around the world, some of which are illustrated on the next 3 slides. Where a cross-border business-to-business supply is made between a supplier and a customer in countries that do not share an indirect tax regime, as is frequently the case, the place of supply is usually the customer's jurisdiction. The supplier will not usually be required to collect or account for indirect tax. However, the customer may be required to account for indirect tax in respect of the purchase, depending on the applicable local regime. For example, for a supply from an EU-established supplier to a non-EU customer, the supplier would generally not be required to charge or collect VAT, although it must verify that the customer is a business customer in order to treat the supply as exempt with credit. That is to say, a supply in respect of which VAT is not chargeable, but which still grants entitlement to recovery of input VAT. Conversely, for a supply from a non-EU supplier to an EU-established customer, the customer would typically be responsible for accounting for VAT directly to the tax authority in its own jurisdiction, under what is commonly known as the reverse charge procedure. If the customer is entitled to full input VAT recovery, it will claim the corresponding credit in the same VAT return, thus eliminating any cash movement in respect of that VAT. There are notable exceptions to certain types of supply, including supplies relating to land, where the place of supply is generally where the land in question is situated.
Where countries share a common indirect tax regime, as is generally the case for VAT in the EU, the cross-border indirect tax treatment of a business-to-business supply will be similar to that described in the preceding slide, but there may be differences, including as regards invoicing requirements. Using the EU VAT regime as an example, the cross-border supply of goods and services between businesses will, in most cases, be subject to a reverse charge on the basis that the place of supply will be treated as being in the customer's jurisdiction. This means that the supplier will usually indicate on its invoice whether or not the supply is taxable, and if so, that a reverse charge should be applied, and treat the supplier as exempt with credit. In turn, the customer will be responsible for accounting for the VAT directly to the tax authority in its own jurisdiction, although if the customer is entitled to full input VAT recovery, it will generally claim the corresponding credit in the same VAT return as noted earlier. As for the cross-border supplies discussed on the previous slide, there are exceptions for certain types of supply. A common example relates to the supply of goods that are already located outside the supplier's jurisdiction, perhaps in a warehouse in the customer's jurisdiction. Here, the place of supply will typically be the jurisdiction in which the goods are located, requiring the supplier to be registered for, charge, and account for VAT in the relevant jurisdiction.
For most domestic supplies of goods and services business to business, indirect taxes will be charged and collected by the supplier, who will be responsible for accounting to the relevant tax authority for the tax collected, although it may be able to deduct indirect taxes incurred on the inputs attributable to its supplies. Again, there are exceptions, but these are not considered further here.
To illustrate some of the supply-side implications of changes to supply chains, let us consider a hypothetical EU-based distributor of pharmaceutical and medical products whose usual methods of distribution may be affected by the COVID-19 crisis. This distributor, which supplies business customers only, may find itself unable to supply customers in certain jurisdictions due to restrictions on the export of its products. It may simultaneously be faced with increased domestic demand for its products. In these circumstances, the EU-based distributor will likely consider a change from overseas customers based outside the EU to either domestic customers or customers established elsewhere in the EU, which will change the place of supply for VAT purposes. In the case of new domestic customers, the distributor will need to charge VAT at the appropriate rate on its invoices, collect that VAT from its customers, and then account for that VAT to the relevant tax authority. In the case of customers in other EU jurisdictions, the distributor is unlikely to need to charge and collect VAT, but will need to ensure that invoices satisfy the requirements for making intra-EU zero-rated supplies. For these purposes, the distributor may have goods stored in another EU country, not where it is established, in which case it will have to determine whether its customers are domestic or based in another EU jurisdiction from the perspective of that country rather than its own. Where supplies are made that give rise to VAT obligations in new jurisdictions, the distributor will need to determine how its products are classified for VAT purposes in the relevant jurisdiction. For example, are they exempt from VAT, and the appropriate rate of VAT. Although VAT is generally harmonized across the EU, the headline rates vary between jurisdictions, and the products to which exemptions or reliefs apply can also vary. The distributor will also need to consider whether the modification to its supply chain results in different tax registration, reporting, and other compliance requirements to those to which it is accustomed. In addition, the distributor will need to consider whether changes to the indirect tax treatment of a supply, including its ability to recover input VAT attributable to that supply, will increase the supply's cost to it, and whether it can pass on that increased cost to the customer. Finally, if, as a result of the COVID-19 crisis, the distributor has had to cancel orders for which it has already been paid, it may have already accounted to the relevant tax authority for any VAT collected in respect of those orders. In this case, it will need to investigate whether it is possible to reclaim that VAT from the relevant tax authority in order to refund it to the customer. Otherwise, the distributor risks being out of pocket.
To illustrate some of the customer-side implications of changes to supply chains, let us consider a hypothetical UK-based supermarket chain whose usual supply network may be affected by the COVID-19 crisis. This supermarket chain may find itself unable to source products from usual jurisdictions due to transport restrictions, or may need to find new suppliers due to increased demand for certain products. For our UK-based supermarket chain, a change from a domestic supplier to an overseas supplier, or vice versa, would not normally alter the fact that the UK VAT regime applies, or the rate of VAT due, as the place of supply should be the UK in either circumstance. However, for domestic supplies, the supermarket chain will be required to pay VAT to its supplier, which will account for that VAT to the UK tax authorities, while for cross-border supplies, the supermarket chain will generally be required to account for either import VAT or acquisition VAT, depending on whether the supply comes from outside the EU or inside the EU. However, if the supermarket chain takes possession of overseas goods where they are located and arranges its own transport to the UK, the place of supply would typically be the location of the goods when the supermarket chain takes possession. This could expose the supermarket chain to overseas indirect taxes, which may apply at higher rates than domestic VAT, with potential cash flow implications. Depending on the applicable tax regime, the supermarket chain may not be entitled to credit or relief for foreign indirect taxes incurred. If credit or relief is not available, this would increase the cost of the supply, unless the supermarket chain is able to negotiate a corresponding discount with the supplier. If credit or relief will be available, the supermarket chain will still need to finance the tax charge up front. As a result of switching to an overseas supplier, a customer may also face new or different obligations in relation to customs duties. This is considered further on the next slide. Where the COVID-19 crisis requires goods to be sourced from new overseas jurisdictions, similar considerations to those that apply to indirect taxes will also apply to customs duties. Changing supplies can significantly increase customs duties. Although they are generally applied on a product-specific basis, there can be significant differences by source country due to either duty elimination programs like free trade agreements or punitive measures such as those in place today in the United States against Chinese imports. This could increase the cost of the supply as well as imposing potentially onerous compliance obligations.
To conclude, hopefully we have demonstrated the importance for companies and organizations experiencing or contemplating changes to their global supply chains as a result of the COVID-19 crisis of looking carefully at the indirect tax and customs duties implications of each step of their supply chain. In particular, they should consider whether the changes result in new indirect taxes and customs duties, in which jurisdictions and at what rates, which party needs to charge, collect and or pay those taxes and duties to tax authorities, whether the changes to the supply chain result in any filing, registration or reporting obligations related to these new indirect taxes and customs duties, whether indirect taxes paid to the relevant tax authority in respect of supplies that are ultimately not made can be recovered, whether relief or credit is available for indirect taxes that arise as a result of changes to the supply chain, and if so, the mechanism for obtaining such relief or credit, and if relief or credit is not available, the impact this has on the cost effectiveness of the relevant step in the supply chain, and the impact on the pricing of subsequent steps in that chain.
So thanks, Kitty. Thanks, Matthew. Just some concluding remarks before we wind up the webinar here. As you all know, every efficient supply chain is built in part on sound international tax planning. And the COVID-19 crisis is requiring all multinationals to reassess their tax planning for their supply chains. Is their transfer pricing consistent with evolving functionality? Is this the time to adjust, to reassess their LRD structures and the margins associated with their limited risk distributors? Does the international structure still work in light of employee dislocation? Is it still possible to maintain a sufficient level of substance in our controlled foreign corporations in order to avoid a CFC income inclusion? As Matthew and Kitty just alluded to, is our VAT system still in compliance? What additional registrations do we need to be dealing with, and do the potential increased VAT costs change how we might change the efficiency of our supply chain? And similarly, in light of the old adage that a crisis is a terrible thing to waste, are there opportunities to improve the structure in light of depressed values and depressed margins? Is this the time to be taking a fresh look at where we should locate intangible property? Is this the time to move IP to a different location to improve the overall structure? All multinationals have are engaging in crisis management, and our message, our concluding message to all of you is that the internal tax departments of multinationals should be an integral part of every multinational's crisis management team. And obviously it goes without saying that Mayor Brown is available to help in connection with that analysis. And so just before we wrap up, we just wanted to make you aware of some additional resources, some recent and upcoming webinars. We just finished a webinar dealing with the U.S. taxation of structured notes, the first in a series of tax issues associated with financing transactions arising from the COVID-19 crisis. The link is there where you can listen to the webinar. And then as Astrid mentioned earlier, at the end of next month, we will be doing a webinar on intragroup financing, post-BEPS, and tax reform, including COVID-19 considerations. And so that will touch in greater depth on some of the issues that Astrid outlined in connection with the impact of COVID-19 on intercompany financing. This webinar is produced in part under the auspices of our global supply chain and distribution practice, which is a multi-practice group, multi-office team focused on all aspects of supply chain and distribution, and some of the issues and focus areas you see here on the screen. But you can go to our website and see the depth of our supply chain practice. And finally, all of our COVID-19 analysis across all of our practice groups is consolidated on our COVID-19 portal, which you see here, and the link is presented there. We encourage you to go there. It's it covers a broad spectrum of legal and tax issues arising from the crisis, and it's a good consolidated resource. So we encourage you to take a look. And so with that, this concludes today's webinar. We hope this was useful. Thank you very much for your participation. And again, you'll be receiving an email with a link to be able to download the slides and listen again to the recording as you see fit. Thank you very much for your attendance.